A few weeks ago, we noted that there were some troubles in the repo market, that the Fed had to intervene basically to allow banks to finance their reserves using repurchase agreements, and that there was a lot of friction in that market, and that had the Fed not stepped in to resolve it, it was kind of indicating some susceptibility of banks to credit worries. Of course, if banks can't finance their positions, that's got all sorts of ramifications, deflationary in many cases. But the Fed stepped in to avoid that problem and rectify it by committing to pledge facilities to keep the repo market flowing. But there was something that really helped stocks when they did this. And although the Fed is very clear to say this is not QE4, effectively it is. And this is, I think, one of the things that's really driving stocks over the past few weeks. If you look at a chart of the Fed balance sheet, you'll see that it basically had been declining for several months as the Fed wound down the effects of all the various quantitative easing programs it had, and as bonds basically they inject liquidity by buying fixed income. As that fixed income matures, unless they roll it over in the open market, that basically shrinks the balance sheet and in some ways reduces the amount of money in the system, but not necessarily in a major way, but it had been doing it gradually. And basically there's been a U-turn. And because the Fed has needed to pump liquidity into the short-term repo market, money is fungible. So if it goes to the banks, it flows out. And that to me is very interesting. They're committed to this repo facility for the next few months, and it starts to make you wonder, is that what's really giving the stock market a lot of the push that we're seeing? Yes, the headline is always trade, positive news on the trade front. But there are certain red herrings about that. You can't have positive news on the trade front every single day, pushing the markets higher. At some point, that just becomes, at best, buy the rumor, sell the news. At worst, you can argue almost manipulative by people spreading those rumors to keep the stock market higher. I'm not going to go there in terms of manipulative. That was a worst case scenario. But one of the things that had been proven is, as the Fed was pumping liquidity into the markets, equities responded positively. And so I would start to keep an eye on the size of the Fed balance sheet. Although it's not meant to be another quantitative easing round, it actually may be acting in that way. And that could be one of the things that we see that puts a floor on, not even a floor, that keeps the uptrend in place. If the Fed keeps pumping in money, it's very hard for the stock market to have a meaningful decline absent some other sort of exogenous news. And that would be the key that I see here in terms of why this uptrend seems so solid, seems so shows such a lack of volatility that I think the stock market is responding in many ways either overtly or covertly to the pumping of liquidity in. And Mr. Powell can say what he will about it not being another round of quantitative easing, but if it looks like quantitative easing and acts like quantitative easing, you're going to start to see it move into other parts of the economic system, in this case the stock market. And I do think a lot of this rise that we've seen over the past few weeks is a result of the Fed actually taking action within the repo markets.